The numbers didn't look dangerous at first. They rarely do. On balance sheets across major corporations, debt appeared as a familiar line item, structured, justified, even optimized. Interest rates were low, credit was abundant, and borrowing had become less of a risk and more of a strategy. But beneath that surface, something far more fragile had been building. Not suddenly, not recklessly, but systematically. A structure where the stability of entire companies, and in some cases entire sectors, depended not on profitability, but on the continued availability of cheap money. And the moment that condition changes, the system doesn't bend, it fractures. At its core, corporate debt is not inherently dangerous. It is a tool, often necessary for expansion, innovation, and survival. Companies borrow to invest in infrastructure, to acquire competitors, to scale operations. In controlled environments, leverage amplifies growth, but leverage also amplifies vulnerability. What determines which side dominates is not just how much is borrowed, but the conditions under which that borrowing exists. Over the past decade, those conditions quietly shifted. Interest rates remained historically low for an extended period, incentivizing corporations to take on more debt than they otherwise would, not because they needed to, but because it was efficient. Debt became cheaper than equity. Borrowing became easier than earning. This is where the first misunderstanding begins. When people see large corporations increasing their debt, the assumption is often that these companies are struggling. In reality, many of them were thriving, at least on the surface. Revenues were stable, stock prices were rising, and executives were rewarded for maximizing shareholder value. But instead of reinvesting profits into long-term productivity, a significant portion of borrowed capital was redirected into financial engineering, stock buybacks, dividend payouts, and acquisitions designed to inflate valuation rather than strengthen fundamentals. These actions were not illegal. In fact, they were often encouraged by market expectations, but they created a dependency, one that is not immediately visible in quarterly reports. The hidden system that made this possible lies within the structure of modern credit markets. Corporate bonds, leveraged loans, and private credit instruments became the backbone of corporate financing. Institutional investors, pension funds, insurance companies, asset managers were searching for yield in a low-interest environment. Traditional safe assets were no longer generating sufficient returns, so capital flowed into higher-risk corporate debt. This demand created a feedback loop. The more investors were willing to buy corporate debt, the easier it became for corporations to issue it. And the easier it became to issue debt, the less incentive there was to maintain conservative balance sheets. Evidence of this shift is not hidden. It is embedded in the data. Corporate debt levels as a percentage of GDP rose steadily, reaching historic highs in major economies. The quality of that debt, however, declined. A growing share of corporate bonds hovered just above junk status, classified as investment grade but only marginally so. These are often referred to as BBB-rated bonds, the lowest tier before becoming high-yield or speculative. This matters because many institutional investors are restricted from holding junk-rated debt. If these bonds are downgraded, it triggers forced selling, not because investors want to sell, but because they are required to. The implications of this are not theoretical, they are structural. When a significant portion of corporate debt sits on the edge of downgrade, the system becomes highly sensitive to shocks. It doesn't take widespread failure to create instability. A small shift in economic conditions, rising interest rates, declining revenues, tightening credit can push a subset of companies into downgrade territory. That, in turn, forces large-scale selling of their bonds, which drives prices down and yields up. As yields rise, borrowing becomes more expensive, further weakening already stressed companies. What begins as a localized issue quickly propagates through the system. This is where the escalation begins. Because the risk is not confined to individual corporations, it extends to the entire financial ecosystem. Banks, while less directly exposed than in previous crises, are still connected through lending, underwriting, and derivative exposure. Asset managers hold vast quantities of corporate bonds on behalf of investors. Pension funds rely on the stability of these assets to meet long-term obligations. When corporate debt loses value, the impact is not isolated. It spreads across portfolios, balance sheets, and financial commitments. But perhaps the most critical layer of this system is psychological. Markets are not purely mechanical. They are driven by expectations, perceptions, and behavior under uncertainty. For years, the prevailing assumption was that central banks would intervene if conditions deteriorated. This belief, often referred to as a form of implicit support, encouraged risk-taking. If borrowing is cheap and downside risk is perceived to be limited, the rational decision, at least in the short term, is to increase leverage. This is not irrational behavior. It is adaptive behavior within the rules of the system. The problem arises when those underlying assumptions are challenged. When inflation increases and central banks are forced to raise interest rates, the entire dynamic shifts. Borrowing costs rise, refinancing becomes more difficult, and companies that relied on continuous access to cheap credit face constraints. Debt that was manageable under one set of conditions becomes burdensome under another. And because much of this debt is not short-term, but rather structured over multiple years, the effects are delayed. They don't appear immediately. They accumulate. This delay creates a false sense of stability. On the surface, companies continue to operate. Earnings reports may still appear strong, but beneath that, pressure builds. Interest payments increase, margins compress, investment slows, and eventually, something gives. Not all at once, but in stages. A missed earnings target, a credit rating downgrade, a failed refinancing. Each event, on its own, may seem manageable, but collectively, they signal a shift. And when that shift becomes visible, the reaction is rarely gradual. Markets adjust quickly, often overcorrecting. Investors who once competed to buy corporate debt begin competing to exit it. Liquidity, which was abundant during expansion, becomes scarce during contraction. Prices move not just based on fundamentals, but on the urgency of participants trying to reduce exposure. This is not a hypothetical scenario. It is a pattern observed repeatedly in financial history. What makes the current environment distinct is the scale and interconnectedness of corporate debt. The system has grown larger, more complex, and more dependent on conditions that are no longer guaranteed. The transition from stability to instability does not announce itself clearly. It begins quietly, with subtle changes in credit spreads, refinancing conditions, and investor sentiment. These signals are often overlooked because they do not fit the dominant narrative of growth and resilience. But they are there, embedded in the structure of the market. And as these signals accumulate, the question is no longer whether the system is vulnerable. The question becomes how that vulnerability will manifest, and who will be exposed when it does.